Hello, my name is Robert Amato, and I'm the principal here at Compass Wealth Management. Welcome to the second part of our 2024 Annual Investment Outlook, which focuses on fixed income. In our first Outlook video that we posted early January, the link to that video can be found in the video description below. We focused on equities, and we started with a brief history of our stock market guidance and how that lined up with market performance. I plan to do the same with the fixed income asset class today. And the first chart that I'm going to share with you shows an annual return history of the bond market, which is known as the most common investment vehicle for the fixed income portion of a diversified portfolio. I'm going to zoom in on the last 3-year history for the bond market on the right-hand side of this chart. And the -2 you see below the first bar represents a -2% annual return. Now that does include dividends, and this is for calendar year 2021. The middle bar shows a -13% return for 2022, which happens to be the worst annual return recorded in the bond market going back to the mid-70s. Lastly, there was finally a recovery in 2023, last year, with a positive return of 6%. There are two risks that lead to negative returns in bonds. One is credit risk, which was minimal during this period, and the other is interest rate risk, which was the main reason behind these negative returns. The next chart I'm going to show you is the history and projections of the Fed funds rate. As you can see, starting in 2022, the Fed funds rate went from 0 to north of 5% in one of the fastest rate hikes in the post-World War II era. This significant rate hike was the primary culprit for the -13% return in 2022. Keep in mind that negative correlation to bond prices and interest rates. Finally, looking at the dotted lines on the far right-hand side of the chart, the positive aspect of interest rate risk going forward for the bond market is the fact that future projections for rates are down. Now, the bond market anticipates these moves, and this downward projection has already resulted in bond market appreciation, which is good, and that started in the fourth quarter of last year. So, in conclusion here, we're much more opportunistic on the bond market going forward from an interest rate risk perspective. However, we are more concerned with credit risk for bonds as the current economic soft landing scenario may become less likely in the coming quarters or coming years. Therefore, we are staying in the high quality, high credit rating categories of the bond market currently for any portion of client assets that we have invested in bonds. Now, I mentioned at the beginning of this video that bonds are the most common investment vehicles in portfolios, but they're fortunately not the only vehicle. As we have discussed in previous commentary, we not only customize portfolios to our client needs, this is probably the most important thing I'll emphasize today, we also customize portfolios to the level of risk we feel is present for a given asset class. I'm going to go back to the Fed rate chart and highlight the area when the Fed reduced rates all the way to 0 as part of their extremely accommodative policy during the pandemic. We felt that raised interest rate risk for bonds tremendously and led us to seek an income-oriented investment that did not carry this interest rate risk. So in 2020, ahead of the large drop in bond prices I outlined at the beginning of this video, we introduced an income-oriented structured note for client portfolios that essentially swapped interest rate risk for very palatable longer-term stock market risk, which significantly outperformed bonds over this time period. I want to spend the last segment of this video explaining how these investments work. The chart you see on the screen outlines the overall structure of these investments. So first of all, these investments typically provide a potential above average income stream when compared to bonds or a money market fund. For the notes we have issued, this has ranged from 7 to 9% annually. They are most often structured with a 5-year term, where your principal can be tied up for this entire period if they're not called at an earlier date. Now, these notes are issued by banks, and they have two main risks to principal invested. The issuer default risk and long-term stock market risk are those two risks. We use banks that were deemed too big to fail during the financial crisis to reduce that first risk as much as possible. So JP Morgan, Bank of America, Morgan Stanley are the most commonly used. The second and last principal risk can be best shown using a 5-year rolling average chart for the S&P 500 and the Dow Jones Industrial Average, which are the primary indices we use for these notes. It's important to understand if a note is called by the issuing bank before maturity, which can happen typically anytime after 6 months of being in this note, but before 5 years before maturity, then there is no stock market risk associated with the principal invested. It is only if a note is called and goes to the maturity date, the full maturity date, that the principal can be at risk based on a very uncommon drop of greater than 40% in either index over this entire 5-year period. So to illustrate this, the chart you now see shows the 5-year rolling averages. So we're looking at full maturity dates for both of these indices, the S&P and the Dow, and we're going all the way back to 1979. So this includes the bear market of 1980, the 87 crash called Black Monday, the dot-com bubble of 2000, and the financial crisis in 2008. So this is a lot of data spanning 40 plus years. And there were only 3 trading days during that entire span that either index breached a drop greater than 40% on a 5-year rolling average that would have resulted in principal loss. So the summary here is the stock market risk is present with these structured notes. However, the history of a drop greater than 40% on a 5-year rolling average is extremely low, essentially a rounding error. I have one last aspect of these investments to explain, specific to the coupon payments, which are usually contingent upon the same 40% barrier for each index. But it is measured quarterly, and if either index breaches the barrier on the quarterly observation date, the coupon will not be paid. Now, fortunately, this is a rare occurrence, albeit more frequent than the principal risk just described. And to illustrate the history of coupon loss, I'm going to go back to the same chart as the principal risk illustration and add in vertical bars where the S&P 500, that's going to be in blue, and the Dow in orange have dropped below 40%. This has only happened if invested just prior to the dot-com bubble for the S&P 500 and for both the S&P and the Dow just prior to the financial crisis. Please keep in mind, this is not an exact science, and let me explain that, because an index has to be down below 40% from the inception date of the note on the quarterly observation date in order to lose that quarterly coupon only. But it could be below 40% any other day during the quarter, and the coupon would still be paid as long as it moves north of that 40% barrier exactly on that day. So with very poor timing of investing just prior to these two bear markets, if you were to approximate looking at the width of these charts, these vertical bars, that 1 year's worth of coupons were not paid on a note with a contingent coupon rate of, let's say, 7.5%, to make the math easy, that would result in an average coupon of 6% over 5 years, which is actually still a respectable rate. The last thing I'll mention here is since 2020, since our firm has issued these notes, we have not lost a quarterly coupon yet. And this wraps up our 2024 fixed income investment outlook. Now, I do plan to follow up with a subsequent video in the near future that discusses ways to lock in current money market rates safely, considering the fact that the Fed is most likely on a rate reduction path starting this year, which means money market rates will start to drop from their current 5% levels when the Fed starts this process. So, as always, please do not hesitate to reach out to me directly or anyone on the Compass team with any questions regarding this material or your accounts. Thank you so much for tuning in.